Hi, everybody. Thank you so much for joining me. Before we get started, please hit subscribe to follow all of my latest investing and personal finance content. And be sure to check the link on your screen for a special message from our sponsor, The Motley Fool, where you can find the 10 best stocks to buy now. So, Tyler, if you've turned on CNBC or any of the other news channels at all in the past week or so, you know that the banking system is kind of in turmoil right now. SVB financial collapse, I guess that was well over a week ago at this point.
That's it?
Um,
Only a week?
Yeah, that's not the only one. Some other regional banks are not doing too well also. Um, so, what do we make of this situation? What caused it? The cause is obviously, well, one, it's panic. If there hadn't been a massive bank run, SVB Financial would have been fine. But having said that, how concerning is it that a lot of banks have assets on their balance sheet that are now worth a lot less than they paid for them, like treasuries and safe assets and things like that? And two, that banks have these excess uninsured deposits because SVBs were especially high at about 95% of the total. But even the median US bank has about 60% of its deposits uninsured, which is why you're still seeing so much pressure on these regional banks where, FDIC insurance doesn't cover most of their deposits. And so I don't imagine that you're investing too much in banks right now.
I'm not. It's funny. Coming into 2023, before any of this happened, I was like, I should learn more about banks. Like, I feel like it's really something that would be interesting to me, something that I think I could really sink my teeth into. And I got to admit, these past couple of weeks have been a real crash course. Like you will learn more about banking in a crisis than probably like just, when you're sitting there just taking deposits for the 10 years that we had without a banking crisis. So to me, that's kind of fascinating. And like you said, it happened because of the bank run, but that really felt like the straw that broke the camel's back because, like you said, you have this huge intake of deposits, 2020, 21, specifically SVB because of capital raising for a lot of startup companies. They had to park that somewhere. They took on a little extra duration risk by taking longer term mortgages versus shorter term, less returns sort of debt. And then you throw on rising interest rates from the Fed, and then all of a sudden you have the recipe that causes that bank run. So to me, I don't know, it's one of those things where it's like, this has been a very educational experience in where banks go wrong, and when they do, it tends to happen spectacularly bad.
Well, so what is the solution? There's a few things that have been kicked around. One is getting rid of the FDIC insurance cap, and maybe that would solve the problem. Because it kind of is a little odd to me that you could put money in a United States chartered bank and potentially lose it if the bank fails. That doesn't seem like that should be the case. When I know that the government gave an implicit guarantee that they were going to take care of any depositors in a bank failure, they're very reluctant to raise that $250,000 cap, and that cap is totally fine for people like me and you. I don't know about you. I don't have more than $250,000 in my checking account, but it's not enough for businesses, especially, and businesses aren't going to want to keep their money in places where they could potentially lose it just for having it on deposit. So that's one solution.
Yes
The
and
other
no,
one,
though. Yes and no,
well,
because cash management and putting your accounts in sweeps where, it gets swept into a bunch of other, at the end of the day, it gets swept into a bunch of smaller accounts. So that helps to protect that. There are, for a company like Roku that had $500 million in checking, maybe that should have been in some other assets other than a checking account. So the idea that like, oh yeah, it's unreasonable for businesses to do that. It's like, well, if you're sitting on that much cash, it shouldn't just sit in a checking account. That in itself is irresponsible too, regardless of our thoughts on whether or not it should all be insured.
well, we could argue responsible capital management by corporations all day long. That's half of what we
Great
do on
content.
here.
Great content.
Yeah, that's half of what we talk about. But at the end of the day, U.S. banks are either safe places to put your money or they're not. So The other thing is walking back the regulatory threshold, because just to kind of give you a quick history spiel, in 2018 there was legislation passed that raised the threshold for what's called a SIFI, a systematically important financial institution, from $50 billion of assets to $250 billion of assets. SVB was right around 200 billion. So under the old framework, they would have been considered systemically important and would have been subject to a lot more regulatory scrutiny that presumably would have uncovered a lot of their weaknesses that led to their collapse.
That
So is the
and
threat
also just happened to be some of the people that lobbied for the raise. Just throwing that
it,
out there.
you're not wrong, but is the solution walking that SIFI threshold back? I don't know if it's that solution, if it's raising the FDIC cap, but what you can't have no confidence in the banking system. You just can't.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.